Friday, the metals markets crashed. Gold fell 4%. Silver dropped 5.9%. Copper plunged nearly 4% from its peak above $14,500 per ton on the London Metal Exchange. That was bad enough for traditional traders. But there's another market that most people don't even know exists. A parallel universe where those same metals trade 24/7 with massive leverage and zero regulatory oversight. It's the tokenized metals market in crypto. And when gold, silver, and copper crashed Friday, this shadow market experienced a bloodbath. $120 million in liquidations in 24 hours. Traders betting on blockchain versions of metals, products like tokenized gold, XAU and XAUT, silver contracts, and copper futures, got absolutely destroyed. This isn't just a crypto story. This is a story about how the lines between traditional finance and crypto have completely blurred, how Wall Street's macro trades are now playing out in digital venues with 100x leverage, and how a new generation of traders discovered the hard way that tokenized gold can crash just as violently as the real thing. Today, we're exposing the crypto market you've never heard of, revealing why $120 million evaporated in hours, and explaining why this matters far beyond cryptocurrency. The tokenized metals market, finance's secret twin. Let's start with the basics, because most people have no idea this market even exists. When you hear crypto, you probably think Bitcoin, Ethereum, maybe some meme coins. What you probably don't think about is tokenized copper futures or blockchain-based gold contracts, but they exist, and they're massive. Tokenized metals are cryptocurrency tokens that represent ownership of or price exposure to physical commodities. Think of them as the crypto version of commodity futures or ETFs. XAU and XAUT. These are tokens backed by physical gold. Each token represents a certain amount of gold held in vaults. When gold prices move, these tokens move. Silver contracts, similar to gold, but representing silver exposure through various crypto platforms. Copper-linked products, derivatives and tokens that track copper prices, allowing traders to speculate on industrial metal movements. The appeal is obvious. 24/7 trading, global access, no need for traditional brokerage accounts, and crucially, massive leverage. Traditional commodity markets have trading hours. The London Metal Exchange closes. COMEX has opening and closing bells, but crypto never sleeps. This means when metals start moving violently, crypto traders can react instantly. No waiting for markets to open. No regulatory circuit breakers. Just pure, unfiltered volatility. And on Friday, that volatility destroyed 120 million in positions. The Friday massacre. $120 million gone. Let's break down exactly what happened in the tokenized metals market during Friday's carnage. Silver led the bloodbath. Silver-linked contracts logged $32 million in liquidations. That's the highest single asset loss in the 24-hour period. Why silver? Because it had the most violent move. Traditional silver fell 5.9%, but the leveraged nature of crypto derivatives amplified those losses. Traders using 10x, 20x, or even 50x leverage got wiped out. Gold and copper followed. Gold-linked products and copper futures accounted for the remaining $88 million in liquidations combined. Tokenized bullion products like XAU and XAUT, Tether Gold, dropped over 7%, even though physical gold only fell 4%. The disconnect shows how thin liquidity in these markets creates exaggerated moves. Total damage, roughly $120 million in combined liquidations across exchanges and derivatives platforms in just 24 hours. To put that in perspective, $120 million is a decent-sized hedge fund blowing up. It's not BlackRock money, but it's not retail traders buying $100 worth of tokens either. This represents serious capital, serious traders, and serious leverage. How liquidations work in crypto. If you're not familiar with crypto liquidations, here's how they work and why they're so brutal. In traditional finance, when you trade commodities on margin, you post collateral. If the trade goes against you, you get a margin call, post more money or close the position. You usually have time. Hours. Sometimes a day. Your broker calls you. You can scramble to find more capital or decide to take the loss. In crypto, there's no phone call. There's no grace period. Automated liquidation engines monitor your position constantly. The moment your collateral falls below the required maintenance margin, your position gets liquidated automatically. And here's the cruel part. You get liquidated at the worst possible price because the liquidation engine is selling into a falling market to close your position. Let's walk through a real example. Say you bought tokenized silver at $115 per ounce using 10x leverage. You put up $10,000 but control $100,000 worth of silver exposure. Silver falls to $110. That's only a 4.3% decline. But with 10x leverage, your $10,000 is now worth $5,700. You've lost 43% of your capital. Silver drops to $107, which actually happened Friday. Your position is now worth $2,800. You've lost 72% of your original $10,000. The liquidation engine doesn't care that silver might bounce back. It automatically sells your position to prevent the exchange from losing money if silver keeps falling. You lose almost everything. The exchange protects itself, and you have zero recourse. This happened to thousands of traders Friday. They were long silver at $115 or $120. Silver crashed to $107. Their positions got auto-liquidated at the worst prices. Then silver bounced back above $111 by the end of the day. They were right about the recovery, but leverage killed them before the recovery happened. Why crypto markets moved faster than traditional markets? Here's where it gets interesting. Traditional metal markets fell 4 to 6%, but tokenized metal products fell 7% plus. Why the disconnect? Thin liquidity. Crypto metals markets are much smaller than traditional markets. When selling pressure hits, there aren't enough buyers, so prices fall harder. Leverage cascades. In traditional markets, leverage is regulated. In crypto, you can get 50x or even 100x leverage on some platforms. When liquidations start, they cascade much more violently. 24/7 trading. Traditional metals markets have circuit breakers, trading halts, and closing bells. Crypto never stops, so selling pressure can accumulate without pause. Algorithmic amplification. Crypto markets are heavily algorithmic. Bots detect volatility, pull liquidity, which increases volatility, which triggers more bots to pull back. It's a feedback loop. Emotional trading. Crypto markets skew younger and less experienced. When metals started falling, panic set in faster than in traditional markets where institutional traders are more common. The result, tokenized metals fell harder and faster than the actual metals they represent. This creates arbitrage opportunities for sophisticated traders. When XAU, tokenized gold, is trading 3% below actual gold prices, smart money buys the token and shorts physical gold, collecting the spread when they converge. But for retail traders who don't understand these dynamics, it's a death trap. Emotional trading. Crypto markets skew younger and less experienced. When metals started falling, panic set in faster than in traditional markets, where institutional traders are more common. The result, tokenized metals fell harder and faster than the actual metals they represent. This creates arbitrage opportunities for sophisticated traders. When XAU, tokenized gold, is trading 3% below actual gold prices, smart money buys the token and shorts physical gold, collecting the spread when they converge. But for retail traders who don't understand these dynamics, it's a death trap. The copper story, China's invisible hand. Let's zoom in on copper because its Friday collapse reveals something fascinating about how global macro trades play out in crypto. Copper futures on the London Metal Exchange, LME, hit a peak above $14,500 per ton Thursday. By Friday, they'd fallen nearly 4% to settle closer to $13,000. The move was driven by two factors. Technical disruptions at the LME. The London Metal Exchange experienced technical issues that affected trading. When the main venue for a commodity has problems, prices get volatile fast. Chinese trader positioning. Chinese traders, who dominate copper markets, executed a sharp shift in positioning. They'd been aggressively long copper, betting on continued Chinese demand and the energy transition. When prices hit $14,500, they started taking profits and unwinding positions. That selling pressure hit the LME hard. But here's the twist. Chinese traders can't always access Western commodity markets easily due to capital controls and regulatory restrictions. So where did some of that Chinese copper trading actually happen? In crypto markets. Crypto platforms don't care about your nationality or capital controls. They don't require traditional KYC, know your customer in many cases. They offer 24/7 access and high leverage. This makes crypto the perfect parallel market for traders who can't easily access London, New York, or Chicago. When copper started falling on the LME, crypto-based copper positions got liquidated simultaneously. Not because crypto traders suddenly cared about LME technical issues, but because the same Chinese capital was positioned in both markets. This is the invisible connection. Traditional markets and crypto markets aren't separate anymore. They're two sides of the same trade. Dollar strength. The universal solvent. The broader context for Friday's metals crash was the strengthening US dollar. Commodities are priced in dollars globally. When the dollar strengthens, commodities automatically become more expensive for non-dollar buyers, reducing demand and putting downward pressure on prices. Friday's dollar strength came from speculation that President Trump might nominate Kevin Warsh as the next Federal Reserve Chair. Warsh is known as a monetary hawk, someone who favors higher interest rates and tighter monetary policy. Higher U.S. interest rates typically strengthen the dollar because they increase the return on dollar-denominated assets. The moment Warsh's name started circulating, the dollar rallied, and everything priced in dollars — gold, silver, copper, crude oil, iron ore — fell. This hit tokenized metals just as hard as traditional metals. Because regardless of whether you're trading physical copper or a crypto token representing copper, dollar strength affects the price. What's fascinating is how quickly crypto markets reacted. Traditional commodity markets had to wait for opening bells. Crypto markets started moving immediately on the news. This is both an advantage and a curse. You can react faster, but you can also get destroyed faster if you're on the wrong side. Crypto as Wall Street's shadow market. Let's address the elephant in the room. Crypto isn't a separate asset class anymore. It's become a shadow market for traditional finance. When metals were surging earlier in the week, hitting record highs and posting historic monthly gains, where were traders positioning? Yes, in traditional markets, but also in crypto. Why? Because crypto venues offered speed, instant account creation and funding, no waiting for broker approval, leverage, 20x, 50x, sometimes 100x leverage unavailable in regulated markets, access, round-the-clock trading, no waiting for London or New York to open, anonymity, less regulatory scrutiny, easier for international capital to flow. The article puts it perfectly. Crypto markets are increasingly along for that ride, not as a separate trade, but as a parallel venue where global macro bets now play out in real time. This is a profound shift. Crypto started as an alternative to traditional finance. Now it's become a complementary venue for the same trades. When JP Morgan wants to hedge a metals position at 2 a.m. on a Saturday, they might actually use crypto derivatives. When a Chinese hedge fund wants copper exposure outside official channels, tokenized copper is perfect. Crypto has become the 24/7, high-leverage, lightly regulated shadow market that traditional finance uses when it needs flexibility traditional markets can't provide. The Bitcoin divergence. Here's something crucial that got buried in Friday's chaos. Bitcoin didn't follow metals down. While gold, silver, and copper crashed and tokenized versions of those metals got liquidated, Bitcoin traded independently. This is significant. For years, Bitcoin was treated as digital gold, moving in tandem with precious metals as an inflation hedge and safe haven. But Friday, gold fell 4% and Bitcoin barely budged. This suggests Bitcoin is maturing into its own asset class, a standalone risk asset that doesn't mechanically follow commodities anymore. The article notes, Bitcoin trades independently, suggestive of its growing role as a standalone risk asset. What does this mean? Bitcoin is no longer just a commodity proxy. It's developing its own fundamental drivers: institutional adoption, regulatory developments, network growth, technological improvements. This is actually healthy for Bitcoin long-term. Assets that merely track other assets don't have staying power. Assets with independent value propositions do. But it also means that tokenized metals and Bitcoin are different beasts now. Tokenized gold follows physical gold. Bitcoin does its own thing. The regulatory void. Let's talk about something uncomfortable: the complete absence of investor protection in this market. When you trade commodities on regulated exchanges, the CFTC, Commodity Futures Trading Commission, the FCA, Financial Conduct Authority, or other regulators, there are rules, position limits to prevent excessive speculation, margin requirements to reduce systemic risk, circuit breakers to halt trading during extreme volatility, investor protection funds if the exchange fails. In crypto, almost none of that exists. The platforms where $120 million got liquidated Friday, many aren't regulated as commodity exchanges. Some operate from jurisdictions with minimal oversight. If you get liquidated unfairly due to price manipulation or technical glitches, you have almost no recourse, no regulator to complain to, no ombudsman, just you versus the platform's terms of service. This is the Wild West. And Friday showed what happens when the Wild West meets Wall Street-sized capital flows. Traders brought sophisticated macro strategies, high leverage, and serious money to venues that lack the infrastructure and oversight to handle them properly. The result is predictable: spectacular wipeouts. What Friday revealed about market structure. Friday's $120 million liquidation event revealed several uncomfortable truths about modern market structure. Markets are more connected than ever. A dollar strength rumor triggers metals selling in London, which cascades into crypto liquidations in decentralized exchanges, which affects Asian traders, which loops back to influence New York trading. It's all one interconnected system now. Leverage is everywhere. The fact that $120 million could be liquidated from 4 to 6% moves in underlying assets shows how much leverage is in the system. This leverage amplifies both gains and losses. Crypto is the release valve. When traditional markets experience stress, some of that pressure releases through crypto markets. It's like a parallel shock absorber that absorbs and amplifies volatility simultaneously. Liquidity is an illusion. Both traditional and crypto metals markets showed how quickly liquidity can disappear. Markets that seem deep during calm times become shallow during stress. Retail gets destroyed. Sophisticated institutional traders know how to manage leverage and have access to better risk management tools. Retail traders using 50x leverage on crypto platforms? They're the casualties. The bigger picture. Metals still leading. Despite Friday's carnage, the article makes a crucial point. Metals remain one of the strongest themes of the year so far. Even with the pullback, copper is still headed for a strong weekly gain. Gold continues attracting flows as a hedge against political and fiscal uncertainty. Silver, despite the 5.9% Friday drop, is still up massively for the month. The fundamental drivers haven't changed. Supply constraints in copper electrification and energy transition demand, geopolitical uncertainty supporting gold industrial demand for silver from solar and EVs. Friday wasn't a reversal of the metals bull market. It was a violent correction within an ongoing uptrend. For traders who survived the liquidations, the trend remains intact. For those who got wiped out, lessons were learned the hard way. Lessons for traders. So what should traders take away from Friday's $120 million massacre? Tokenized assets track underlying assets. If you're trading tokenized gold, you're exposed to everything that affects physical gold: dollar strength, Fed policy, geopolitical events. The blockchain doesn't protect you from macro factors. Leverage is a double-edged sword. 10x leverage turns a 10% gain into 100%, but it also turns a 10% loss into total liquidation. Friday proved this brutally. Crypto liquidity is thin. During stress, crypto markets for tokenized metals can fall harder than the actual metals because liquidity disappears faster. Traditional market events affect crypto. Fed chair speculation, LME technical issues, Chinese trader positioning, all of these traditional market factors now impact crypto markets directly. Risk management matters more than conviction. You can be completely right about metals going higher long-term and still get liquidated if you don't manage risk properly. The future. More integration, more volatility. Where does this go from here? The trend is clear. Crypto markets and traditional markets are integrating further. not separating. Institutional traders will increasingly use crypto venues for after-hours trading, leverage, and regulatory arbitrage. More tokenized commodity products will launch. More capital will flow into these markets. This means more volatility. As leverage increases and markets connect, volatility will amplify across both traditional and crypto venues. More liquidations. Events like Friday's $120 million wipeout will become more common, not less. More regulation. Eventually, regulators will wake up to the systemic risks and crack down. But that's probably years away. More opportunity. For sophisticated traders who understand the dynamics, the integration of crypto and traditional markets creates arbitrage and trading opportunities. The genie is out of the bottle. You can't separate crypto from traditional finance anymore. They're intertwined for better and worse. The bottom line. Friday traditional metals markets fell 4 to 6%, nothing unusual for commodity markets that had just posted record highs. But in crypto's shadow market, $120 million evaporated in liquidations. Traders using massive leverage on tokenized metals got destroyed. This wasn't a crypto story. It was a traditional finance story playing out in a parallel venue with less regulation, more leverage, and 24/7 access. The $120 million loss revealed that crypto has become Wall Street's shadow market, where the same macro trades happen with amplified risk and reward. Metals remain a dominant theme for 2026. But Friday showed that whether you're trading physical copper on the LME or tokenized silver on a crypto exchange, the risks are real, the leverage is dangerous, and liquidations don't care about your convictions. The markets are merging, the lines are blurring, and the next $120 million liquidation event is probably just $1 rally or Fed rumor away. This has been your deep dive into finance's shadow realm. Thanks for watching, and I'll see you in the next one.